Welcome to the Smart Property Investment Show. In this episode, regular guest and top mortgage broker Ross Lacane offers his forecast for possible rate hikes in the months ahead. We also look at how investors can navigate tighter serviceability requirements to ensure they've got access to finance. All this and much more coming up in the Smart Property Investment Show. Welcome to the Smart Property Investment Show. My name's Phil Tarrant. I'm the editor of Smart Property Investment. Today I've got two very special guests. They're always special, but these guys in particular are special. I have James Mitchell, who heads up editorial here across our mortgages and real estate suite. Welcome, James.
Thank you.
I've also got Ross Lacane. We're just having a laugh beforehand because I'd said his name wrong, so I had to redo another take on this. Ross is he's my mortgage broker, but Ross is Aussie's number one mortgage broker in Australia. So this bloke focuses purely on investment mainly, and he's a gunner in this game. So welcome, Ross. Thanks for coming along.
Thank you.
Bringing Ross on here, you'll probably guess that today is going to be very much focused on finance. We've got to keep this conversation pretty tight. We've got about 20 minutes or so, and we're going to just pick Ross's brain on what's going on in the finance space right now and how that's impacting property investors. James is going to add in on that. James works across some of our mortgage titles and real estate titles, so he's pretty connected with what's going on in the mortgage space and real estate space from an industry perspective, but he's also very involved in driving the editorial across Smart Property Investment and working with me, so he's going to add to the conversation, give his interpretation on certain things. Now, some background. So a couple of things we want to chat about today. We've spoken at length over the last couple of podcasts around the APRA requirements that happened last year and what's that done with property financing. But we want to have a chat today around that and also serviceability changes and how the bank is viewing investors and what they're willing to lend you and how they're willing to lend to you. And also want to have a chat about alternative ways to get finance. So a lot of investors these days are coming up against some roadblocks with these changes that have happened over the last 6 months to 12 months and having to get a little bit more creative about finding money to borrow, and mortgage brokers are obviously helping them out in there. So a lot of investors I've seen are flocking towards mortgage brokers now more than ever because they're struggling to get finance. So let's kick this off. Ross, can you just remind everyone about these APRA changes? What were they? When did they happen? What were they? And where are we at now?
Midway through last year, APRA's come to the banks and said, look, we want to tighten the way and standardise the way that you lend money. So basically, the main changes is in terms of the money that you're borrowing, we'll put a baseline serviceability rate. So it's around about that 7.25 is the baseline rate that they service the loans against. But there's also some changes on how they assess the existing loan. So we probably had half a dozen lenders that would assess on interest only, for example. So on $1 million, the bank might assess at 4.5%. That's $45,000 a year. Now they're assessing those same loans at principal and interest at about $86,000 a year. So it's an increase per $1 million of about $40,000. So for a client with a couple of $1 million portfolio, if they've got a $3 million portfolio, that's an extra $120,000 in income they have to come up with to service the same portfolio they have. So you can see that with clients with quite sizable portfolio, they just makes it a lot more difficult.
We've spoken about this a lot on smartpropertyinvestment.com.au, and I know, James, you've been driving editorial around this APRA stuff for quite some time. There's a few misconceptions, I think, in the marketplace around banks. So the investors I speak to think that banks have stopped wanting to lend money and therefore they've really gone all out on staying true to these APRA requirements. That's a massive misconception. Banks love lending money. That's how they make money. You look at any bank's balance sheet and most of the value in these banks are the mortgage businesses that they create, So I think everyone needs to understand that banks are only complying with these APRA requirements because it is a requirement for them to do business. That said, they're going to push their thresholds up as much as possible to make sure they don't go above the requirements in terms of growth in investment lending. Now, investment market has been quite hot for the last couple of years. We've seen city market in particular go from strength to strength to strength. So a lot of the original driver behind these APRA requirements was the perception that we need to slow down the property markets. That's a fair call. Is that right, James?
Well, there was a number of things which I guess triggered it. One was that property investment or the number of mortgages that were written for investment purposes were getting too high. And the RBA came out late 2014 and said the market's becoming imbalanced because it's now 50% of all lending. And that's when the whole jawboning started. And then midway through last year, APRA came out with a 10% speed limit and that the banks would have to not grow their investor loan books any higher than 10%. But as is the nature of competitive markets, they're going to be growing them right up to like 9.9%. So there's been a lot of interesting pricing and policy dynamics that came as a result of that. That's with the investor lending. Then you've got the increased capital levels which are coming from global banking regulation, for example, which are also adding to that. So just like we were talking about before with Ross, you've had the two-tiered pricing come in. So owner-occupiers are paying less than investors. Investors are paying more, but then you also had an additional rate hike in November, which was spearheaded by the majors, which came on top of that. So it's interesting to see how that's gonna impact things. So what do you reckon, Ross? How have those two rate hikes, I guess, as it were, for investors impacted sentiment?
So just to be clear, these aren't RBA rate hikes.
No.
These are the rate hikes. So maybe explain why and how banks push up rates out of cycle, because a lot of people don't understand that. So if you can just give our listeners a little bit of an interpretation of that, but then also what James is saying, what's the flow on of that?
Yeah, so if you're on a variable rate loan, the bank has the right to move those rates at any time, given the name variable. So it started with one of the majors coming out and raising rates for investors by around about 0.17%, I think it was.
Let's name them. Who were they?
Yeah, I think Westpac led the way,
okay.
And then the others followed in that respect. So with a variable rate, so investors on their back book, they received a rate increase. And then the next one was for everyone, for owner-occupiers and investors. The reason they cited was those capital requirements that James mentioned. But it's interesting to see now that that's been a few months down the path. You're seeing a lot of now, and especially in the investment side, I think because the market, I get the feeling in sort of January that it's a little bit slower in terms of, and they're well under those 10% cap. So they're looking to bump up the amount that they're lending. So there's quite a number of under-the-table offers coming through.
What do you mean by an under-the-table offer?
If CBA says, look, we're going to drop rates to, for example, to 4.3 for investors, then it's normally, James, and you can confirm this, it'd be about 2 days and everyone else would drop their rate to 4.3%. So the banks, get smart and said, we'll go to certain top performing brokers and say, look, we'll give you these special offers that you can take to your clients, and so that way it doesn't get in the broader market.
Sorry, just interrupt. So if you get that phone call, say if you, or however they communicate with you as a mortgage broker, so you go, all right, so I'm a top broker, which you are. I'm not going to big you up too much, mate, but you're pretty good. Do you get on the phone and would you say, like, to a guy like me, Phil, mate, I know you're looking to settle that property or do whatever. Let's go with Westpac because I've just got this rate here and I know they want your business. Let's go with those guys. Is that what you do?
Yeah, well, there's a number of factors that come into it. Serviceability, where you are in your portfolio, who your existing loans are with. If it makes sense, and we've been looking at a number of investors this week, for example, a couple $1 million portfolios, rates above the 5%. You can save them 0.6, 0.7 on their portfolio. You're looking at saving them $10,000 or $12,000. So if I'm not coming to you as your broker and saying, hey, look, there's an opportunity to save that sort of money, then I wouldn't be looking after your best interests. So it's about looking after the best interests of the client and taking in all their factors into account. But yeah, I definitely, if it suits, for sure.
If I don't have a mortgage broker, I'm never ever going to hear about these things.
Yeah,
because they're under a sort of...
Yeah, you're unlikely. I mean, I recommend everyone should be contacting their existing lenders, and if you are paying above 5%, speak to them about what they can do, because quite often a phone call will get you quite a bit to your existing lender.
So let's stick on that. Yeah. So I'm just, I've got a couple of investment properties. I don't have a relationship with the broker. I deal with the bank branch down at the local mall or whatever it is, right? Do I march into the bank and say, I want to speak to the bank manager, I want a discount on my home loan, or do I pick up and speak to whatever call centre and say, hi, this is who I am, look at my loan details, I think I'm paying too much for my loan, my mate is getting this rate, I want the same. Is it as simple as that?
Pretty much.
Yeah.
And the ones that ask will get the discount. So, and that's, as you mentioned, the bank's profitability, a lot of it comes from their $1 billion of back books in terms of the mortgages that sit on their books. And that's where they make their money. And, I will guess, but 70 to 80% of people never ask the question. It's the 20% of the people that ask the question.
Always ask for a discount.
Always ask for a discount.
James, you mentioned that the banks are redlining on the restricting the growth of their investment business. It's got to be under 10%. So they're redlining at 9.999999%, right?
Yeah.
Because of the requirements that come in place, and obviously there was a bit of a wholesale shift towards we've got to slow down. But now a lot of the banks are realising they've probably got a bit of capacity to keep pushing forward, and that's a dynamic of APRA puts in the requirements to slow down price growth in the investor space, and that's probably happened, right? So there's a lot less investors in the market.
It's definitely
as a result of it, and serviceability and pricing has been harder, so there's less investors. So banks now going, it'd be nice to win some more business from the investors.
Dial that up a tiny bit, yeah.
If I'm an investor now and I don't have a relationship with X bank and I'm thinking about refinancing, am I going to be able to get more preferential pricing from those guys now because they want to win my business? Is that the way it's going to work?
There's a big trend now, and it's sort of been debated, a lot, where banks are looking to win new business and they're offering better rates to win that new business. And it's been some interesting discussions, especially that we've been running in our stories about, well, what about the existing customers? What happened to the customer loyalty? Because it's all about that new onboarding. So that's an interesting dynamic. But I think where investors in particular have a really good hand to play in all this, and where they've got an advantage is when banks start to get creative with, we've dropped down to maybe 8% growth, we can ramp it up to 9ish again. Whatever they're doing, they're going to be communicating with brokers, and like Ross said, some of the top performing brokers they'll be doing these deals with. And so I think it's really important for investors to be speaking to their broker, or even if they're a bank branch type of investor and they don't use third party, to even shop around different brokers. That's something we're starting to see through reports that we're doing, is that investors are actually shopping around brokers like they do with banks, because it's such a prevalent channel at the moment.
And just sort of generally, do you think property investors, from your experience with talking to them all the time, do you think most of them are focused on the property or where they're buying rather than the finance around it? Do you think finance is always a secondary thing for most property investors, and it's just I
think it probably doesn't get enough coverage. It definitely doesn't get enough coverage. Yeah,
I think it's more about the strategy. If 0.1 of a rate or 0.2 of a rate, and let's face it, that's most of the time what you're talking about. It's not a huge difference. And if it means the difference in the ability to grow your portfolio, to get that extra 1 or 2 or 4 properties, and that's part of what we do in our strategy meetings. We'll sit down and plan somebody's portfolio, and we might take them to X bank first because we know their requirements are going to be easier at this stage of their portfolio, and we might go to XYZ bank down the track once they're 3 or 4 properties in, because we know that the serviceability will be better with that particular lender down the track. So you're planning out their portfolio. They may pay 0.1 or 0.2 higher in interest rate, but compare someone like your portfolio or my portfolio and look at the gains that we've made over the last 3 or 4 years. That is minimal to the 0.1 or 0.2 extra. If you've made $1 million in equity over the last 5 years, you're not worried about if you're spending an extra $500 on interest on that particular loan.
So don't get too obsessed about the interest rate. As long as it's low enough, don't sweat it too much.
Well, as long as you can continue to grow your portfolio, because the property investment is about the major gains come from the capital growth of the property. Yes, it's definitely worth looking at your numbers and looking at cash flow and looking where you can tweak and save that, because that's your ability to hold the property long term, is how much cash flow is coming in and out. So you always have to review your rates, speak to your broker, speak to your banks about reducing rates so you're paying as low ongoing costs as possible, but so you can hold the properties long term to get that capital growth, which is the real thing that you want.
So let's chat about serviceability. So as a property investor, my goal has been to, and I've embarked on a strategy which is decades long, buy and hold. but I'm always looking to buy that next property. These requirements that have come in and rates have been pushed up a little bit by banks out of cycle, and the way in which they view me as a lender has changed because they look at me as P&I rather than interest only, and that changes my serviceability and ability to borrow. They've also started to do some view serviceability a little bit different recently as well, where the more properties you have, they look at the living expenses component of that as well. And a lot of investors are finding that a little bit inhibitive to buy more property because they've reached their serviceability ceilings and they can't do anything about it. Can you explain that dynamic a little bit?
Yeah, definitely. This is something that the banks are looking at because of the regulators are coming down a lot harder on them in regards to living expenses. So previously, the same benchmark was used for somebody earning $50,000 living in the outer suburbs to somebody earning $500,000 living in Paddington, for example. So the living expenses aren't the same, and so the regulators realise that. So they're putting the onus on the banks to say, based on your income is going to be based on what the lowest benchmark you're going to need to use for living expenses. So this is something that we're just seeing over the last couple of months that we've seen some changes in, and we expect more changes around that living expenses to come in. But yeah, again, another reason to sort of speak to your broker, because living expenses is something that as brokers, we need to, on every client, we need to do a detailed expenses in terms of what they're doing, not just their assets and liabilities anymore, more, from a personal living expenses as well.
And are the banks taking that very seriously? So the interpretation of what they expect someone to be spending on their life outside of their mortgage. So how's that practically going to play out for someone's ability to get more financing to buy another property or refinance?
That will come into play, and it's part of the whole responsible lending. And if someone's paying, private school fees is a great example. That's a massive expense for somebody. Previously, hadn't been declared on a standard liability sheet. Over the last couple of years with the responsible lending as something that's come in that we need to factor in. So the banks will now factor those types of expenses in your overall borrowing capacity and reduce the amount that you can borrow.
So if I'm at a serviceability threshold and the banks have said to me, no more money, you've either got to I can't lend you anymore because you're redlining your serviceability. What can I do? It's a question for both you guys and the conversation you have with people, James. What can I do to sort of just bring that serviceability back and be more attractive to a bank? Do I stay with the same bank? Do I shift banks? What do I do?
Well, there's a number of things you can do. You can look at your overall asset and liability position. So in terms of, get rid of some high interest sort of credit card limits and so forth.
So that's the limit. So the bank will look, if I've got $100,000 available to me in credit cards, but I only have a balance of $1,000, the bank's going to go, nah, Phil, mate, that's $100,000.
Yeah, you can go to the casino and put that on black tomorrow in the bank size. You can put that 100,000 and you can be up to that limit. So, so credit card limits is a big thing. Things like consolidating, personal loans or car leases or repayments like that. The other thing is to look at your interest rates, as we've discussed before, in terms of making sure you're paying the best deal that you possibly can. Increasing rents. Quite a lot of investors are passive and don't review their rents on a regular basis, and also look at other opportunities in your portfolio. We had a case where someone was at their serviceability limit, looked at his options, and he decided he was going to put a granny flat at the back of one of his properties, which considerably increased his cash flow and then changed his ability to borrow. So there's a number of things you can do.
What about switching lenders? So I know you do a lot of work, James, on our mortgage title. You advise with some of the sort of second-tier banks or non-bank lenders. Those guys are open for business, aren't they?
Absolutely. And I think when a lot of this noise started happening midway through last year or late last year, one of the non-banks in particular, made no secret of the fact that they were going after the investor space.
Who was that?
That was Liberty.
Okay.
A lot of the other non-banks weren't as aggressive in their messaging around that, if you like. But Liberty said they're open for business when it comes to investors. they're looking to take that business, and they've got more flexibility and alternative options. So I think and they do that. They've got the products and they've got a pretty sharp rates at the moment, and that whole non-bank space has changed so much over the years. It used to be credit impaired, non-conforming. Now there's so much prime deals, going on in that space. So it seems that the brokers that I'm speaking to at the moment, and this is an interesting trend, is that there's been a big proportion of brokers who haven't typically used the non-banks, but because of what's happened recently, they're now looking towards that space and being like, oh well, I've got an investor client who's bought 6 properties, wants to buy their 7th. Oh, I'll put them with a non-bank, and so it's really changed. It's really changed things around, and it brought a lot more competition into the market that way. But it's definitely something that the non-banks are looking at. Yeah.
Brilliant. Well, that's all we've got time for this podcast. Ross and James, mate, thanks for coming in, guys.
Thank
really
you.
Enjoyed it. We can chat about this all day. Don't worry, Ross will be back. We'll get him in again shortly. Look, is there anything you particularly want to know from Ross or from the mortgage broker side of things? Get in touch with us. You can contact me at editor@smartpropertyinvestment.com.au. You can also follow me on Twitter at Tarrant. But make sure you check out SPI, so smartpropertyinvestment.com.au. We're on all the social networks, Twitter, Facebook, etc., etc. And thank you also to everyone. We are ranking really high. This is the most popular property podcast on the on iTunes at the moment. We've ranked in the top 5 business podcasts in Australia for the last couple of weeks. So I'm really stoked about that. It just goes to show that what we're talking about, it's the sort of stuff that you want to listen to. But if there's any way that we can improve, please let us know. If you want to punt me and put someone else in there, I'm happy to hear about that. But if you like what we're doing, jump on iTunes, give us a review. 5 stars is brilliant. And leave us a little bit of a note. But please do get in contact. Guys, thanks again for coming in.
Thanks for having us.
See you soon. Bye-bye.